On today's episode of the Finance podcast, I have the pleasure of welcoming back one of our most popular guests, Ted Oakley, who's managing partner and founder of Oxbow Advisors. So, Ted, it's wonderful to have you back on. Thanks for coming.
Thank you, Anthony.
No problem. I'm really looking forward to our conversation. I guess since we last spoke, I think it was close to sort of the height of the banking crisis and when there was a lot of concern. But I guess since then, if we look at overall market performance, things have gone up quite a lot. There's maybe a bit more positivity about what's happening in the world. So I guess from your perspective, what are you currently seeing from an economic perspective, and what are your thoughts about what we've seen maybe over the past 3 or 4 months?
Anthony, this really reminds me of the year 2000, where we had a sell-off in the NASDAQ pretty hard into the spring and summer. And then it rallied back. And if you caught that rally, the next 3 or 4 months, you went on up and you caught a high, when we got into the fall. And then, of course, it rolled over in '01. We just kept on going down. It reminds me of that, actually. It's where people, we never cleared a new high in this whole cycle. The high was still January 21. And so everybody's talking about a new bull market. I'm like, well, you haven't cleared the old high yet. So you're certainly not in a new one. But I think that's what's caught people off guard. A lot of speculative money is still in the market. It's surprisingly enough, you'd think after 2022 wouldn't be there, but it's still there. And that's why you've gotten these big 10 stocks driving the 10 stocks that are driving the S&P. Now, by the way, I think they've topped, but that's what was happening in that 4 or 5 month period. And if you look at it, I told somebody this morning, I said, look, 2 years ago to the day, the S&P and the Dow Jones Industrial Average were exactly the same price they are today, 2 years ago. Now, would you go nowhere? And if you look at it, the 3 month Treasury bill then was 0.0004. In other words, it was four basis points. Now it's 555. So you've got a forward multiple on the S&P of about 21, which you don't start bull markets from there. So economically, we feel like we're at this spot. Typically, when the Fed starts raising interest rates, when they start, normally, if you look at history, 20 to 22, 23 months out is where you get the recession to really be seen. In other words, you can see it. Everybody knows it's a recession. I think that's where we are. If you look at it and look at where we are, we're probably, 18 to 20 months. I think we're right there, where you're going to be seeing that show up. And with this last round of interest rates that have moved up, with the long bond, particularly the mortgage rates at 758 this morning, that's probably going to throw more cold water on it. But that's how we see it right here. We're not much change. We still have a lot of liquidity.
Yeah, and as you said, it's if we compare the economy 2 years ago, a lot has changed compared to, as you said, not just from the bond yields, other factors as well. Yet the market still has remained the same.
Well, 2 years ago, if you'd said, okay, hey, look, we're going to raise interest rates by 5.5 points, and the market's going to be, the earnings are not going to really come around, so you're going to be selling at the same price, but 21 times now, I think people would have said, well, that's too expensive. That market's probably has to come down some. And what's happened in this last 4 or 5 month period, I keep saying this because we have all these speculative juices and people in the marketplace, one-day options, all that sort of thing. And normally in a bear market, you have to go low enough to wipe those people out. I've seen it time and time and time. I could take you back to the early 80s when they got wiped out. They were all trading oil stocks. They were all over the place, trading these little bitty oil stocks. Everybody was doing it all over the nation. Take you back to the late 90s and when people started, hey, I'm day trading now, quit my job. All of that goes by the wayside. And that's where we are right now with these people taking small amounts of money and speculating with it. And you have to basically wipe them out. And then you get back to a low and start the thing like it should be, based on valuations.
Yeah, it does seem like sentiment is swaying quite a lot. As you said, those maybe speculative investors were probably quite negative at the end of last year, start of this year, but then they've had a bit of euphoria over the past 6 months. So I guess from what you're saying, you expect maybe it's potentially peaked, and then from there it's going to go back down.
You know, Anthony, I'll give you some really good, really anecdotal evidence here, just to give you an idea. And we work with people all over the United States and foreign too. And I've had a number of them talk on the side, just say, hey, my son or daughter is doing 1 day options. They're trading options on those top 10, that sort of thing. They really got caught up in Nvidia and Tesla and all that sort of stuff. And for a while there, they get really about a 2 month period. They were saying, they were just talking about how much money they made, how much money they made. In the last 3 weeks, I've heard from nobody because all of those stocks are, we think most of those peaked about 3 weeks ago. And I really feel like they'll certainly underperform going through the rest of the year.
Yeah, I agree. So if we go maybe more to the Fed and what they've been doing, we've mentioned before that they've raised interest rates at a very fast rate. And it looks like there's always this thought that they're going to pivot or they're going to stop raising, and then we get some inflation data and then or employment data, and then it's like they're going to continue to raise. So from your perspective, I guess what are you thinking is going the Fed are thinking, and then what are your thoughts on inflation and maybe the trajectory that we've seen this year?
There's a lot of deflationary forces working right now, and we're starting to see some of them come into play. I think one of the problems is that housing, particularly apartments, comes in late. In other words, they were able to raise those rents really a lot over the last 12 months, but now they're not able to raise them. Where they're used to raising rents by 4, 5, 6, 7%, they'll probably be lucky the next 2 years to raise them 1% a year. And that has to catch up in the CPI data, number one. Okay. Number two, you've got this move in oil, and that's obviously throwing those numbers awry. So it's probably going to keep the Fed at a position where they say, well, we may not raise rates right here all the way. Maybe we would, maybe we wouldn't. But we're certainly not going to start lowering them. And I think people on the outside have to realize, let's just say, okay, that they can't get the inflation rate lower than 3%. I mean, use that number. And I think that's historically, that's an average number. Then if you look at the spread on the bonds, the 10-year is usually going to be somewhere around 1 3/4 higher than that. So you're still at a 4.5, 4 3/4 10-year, see? So even when you go back to a normal curve is what I'm saying. And so, because you have to have something built in if you're going to own something 10 years above the inflation rate. And I think that's what people probably are missing. That's why we kept a lot of money. Very high percentage of money that we've kept, less than a year maturity. So we'll see how it plays out. I never believed the Federal Reserve. So, since Volcker, I've never believed any of them. But maybe this time the chairman is really serious about making this happen. I guess we'll just have to wait and see what happens with him.
Yeah, and you mentioned there so deflationary trends. Is that because you think that there's going to be a recession moving forward as well?
If you go out in the marketplace now, you'll see, Anthony, various things, not food, by the way, but other things, materials, certain things you use in certain businesses are basically coming down in price. Now, I have to remember, if China, which is really stumbling right now, they're having a lot of trouble, they're probably going to export that deflation to us, probably. If I were them, that's exactly what I would do. I would keep selling. I've talked to so many people. And I said, well, why don't you have it made somewhere besides China? And they have the same answer every time. I can't do it as cheap anywhere else. I can't even do it as cheap in India. So I think that's going to be working too. And that's why it's so hard here to make a call. I think people that can say, hey, inflation's coming down, inflation's going up. I think you just have to manage a portfolio so that you're not going to get hurt either way. Okay. And I think that's the important part in here.
Yeah, and if the dollar continues to strengthen and other factors as well, that will benefit the consumers in the US for those sort of type of products.
Yeah, they sure would.
Very interesting. So you're saying that moving forward, there could, even though there might be deflation, it might not be as much recessionary. There could be sort of that China effect as well. Or with higher interest rates, if that remains longer, is there more chance that sort of they could permeate throughout the economy and and maybe we see those bankruptcies that you mentioned in our last conversation.
Anthony, if you look at any business, it could be an individual business, it could be a corporation, it could be anything that derives revenue. Okay. When times get really tight and they can't bring in as much revenue, most of them, not all of them, but most of them cut the price. Whatever they're doing, could be a service, could be something you use, materials, but that's how they keep it going, so to speak. And so when you get in harder times, you have to remember that, because that's what will happen. They'll cut the price. And we're not there yet because we haven't really hit the recession button, but I think we will get there eventually.
Yeah, it makes a lot of sense. So then I guess from that perspective, then would you see that, do you think the Fed would cut rates very quickly, sort of similar to how fast it went up, or do you not think it will be as fast as of a movement of that
Well,
as that?
I really do think that we're in for a precarious stock market for the next 6 months. And I said early in the year that I thought by the time we got to the third or fourth quarter, we would be in tougher straits. And I still think that way, even though it's been a little longer than I expected. I still think we're going to go there. And if that's the case, if you were to, in fact, and I don't know this, it does happen from time to time, but if you had a 25, 30, 35% decline in stocks, I would guess the Fed they may not loosen up as far as cutting rates, but they'll make it very well known that we're not going to raise any more, because, we're probably where we need to be. My guess is they would do that. That'd be one outcome. The other outcome is you just start showing up. Business is so bad everywhere that they're like, hey, you got to have some help. And then they quit raising rates, and maybe eventually they lower rates. But they've had a really hard, fast move, and somewhere along the way, I don't know where it is. Maybe it's late 24, early 25. That's such a hard thing to determine that we don't. I can say this for sure: we have zero interest in trying to predict where they're going to go, but we always try to have the kind of portfolio that we can function with it no matter what they do.
Yeah, it's definitely a fool's game trying to predict the Fed, because I don't think even Jay Powell knows what they'll do in a few months' time. So, yeah, you mentioned there that you sort of got a portfolio that's hopefully weighted for that, where it's sort of going to benefit either way. Can you maybe talk more about that, and I guess how that's changed maybe over the past few months?
Well, Anthony, I would probably, for lack of a better term, I'm not great at this stuff, but lack of a better term, I would say it's an all-weather portfolio. And by that, I mean, we have quite a bit of money that we have very short term. I'm saying part of it's floating rate, so it adjusts automatically if rates are going up. Of course, they come down as well. And then we have some mid-range stuff at 1 year. And we even have a few things. This is all Treasury now at 2 year. And we have some great short-term municipal bonds as well. But we have that on the short end. And then we have I'm talking about income accounts. I'll talk about stock in a minute. But on the long end, we have about 15% of the portfolios, 15, 16, 17% that are in the long-term bonds as well. Okay, what does that tell you? It tells you that, yes, we're skewed toward the safety end, but just in case the bonds get on a run, we have some at the long end. And that's where we are in the income portfolio. On the stock side, what I call all-weather is this. We do not see the types of values out there. We have stock screens. I know you talked to Chance Finucane, our chief investment officer, before, and we have screens for 200, 250 stocks, have a good idea where they're valued and where their really good value is. We just don't have many on the list for sure. There are a few. If they pop up, we take a position in them. But right now, there's nothing there that tells us that we should be really, really aggressive on the stock side. Now we can be 95% invested really quickly, or we're currently we're not even quite half invested if we're that actually. But that just allows us some leeway if in fact we get what we expect, which is probably somewhere out there lower prices. If it goes on up, I'll just give you an example of an all-weather. We're about half in the market. We have good companies. They're all doing well. They've all made good money. We really don't have any problem children right now. So you might say, and people say this to us this year, well, you've missed the market move this last 4 months. And I'm like, well, no, we didn't. We're up actually on a cash adjusted basis. We're beating the market because we've got good companies, but we just happen to hold about 52, 53% cash right now.
Yeah, it makes sense. So from what I'm hearing, and I guess the challenge is how does someone be so patient during such a period? Because I guess a lot of people want to be always fully invested
Yeah.
and don't want to be patient. How is that? How do you do that?
My advice to people, whether they would ever use Oxbow or any firm for that matter, is if you're with a firm and the portfolio managers do not have the capacity at times not to be in certain sectors of the market or not to raise cash, you're probably with the wrong group, okay? Because you need people that have the ability to say, hey, this is not right, or this is really, really right. And when that comes along and you're talking to me, everybody's going to be scared out here, I can tell you. But you have to have portfolio managers have the ability to go against the grain and say, there's something wrong here, and it's no valuations aren't correct. It's all speculation, and that can go on for a while. People do okay with it for a while, but in the end, if you look at a 5 or 10 year period, that doesn't work.
And I guess how have you built that patience yourself?
Well, people have to understand what your values are, where you are. If you let people know, look, this is the kind of companies we're looking for. If you look, one of the things I always like, we buy individual companies. We do not buy indexes or ETFs. Here's why. When the market sells off, and let's say the 16 or 17 companies we own right now come down in price, which they probably will, okay? And you get into a 2008 kind of situation where people are scared to death, okay? Then you have to have the ability to sit down with them and say, look, you own a business. Let's forget about the stock market. You own a business, and it is a really good business. This business is, it has cash returns of 20% a year as far as everything combined. And you go through the businesses, that's what you do. That holds people in the market, and you don't get shaken out of the market like that. But you have to have liquidity because you're going to have to be able to take advantage of some cheaper prices. On the upside, it's the same way. When things get really, really pricey, I'll give you some examples. We have small positions left right now in Apple and Microsoft and Google, okay? But we've sold them all the way up, a little bit at a time. Now they're small positions at very, very low cost basis, but those stocks have probably, for the time being, have probably peaked. We're not going to take any more out, but we don't own much of them now, not like we used to. Hope that makes sense, Anthony.
Yeah, it definitely does. Thanks for explaining that. So, if we go back to your thoughts on, I guess, what you're going to see in the next 6 to 12 months, you're thinking it's going to be very rocky moving forward with potentially topped. And from there, we could see a reversal. You mentioned before 20 to 30%. Is that what you're currently seeing at the moment?
Well, let me just give you some examples of what's happening. If you look at Wall Street, what they were expecting for earnings on the S&P 500, and you go back to January of 23, okay, from that time until now, they've lowered those expectations by about 10%. We think they'll lower them even more. In other words, they're down to around 218, 220. We think they're going under 200, maybe 180 or 190. But the point is that if that does happen, and we think it will happen, then the market's overvalued for sure. And you have to have a recalculation of where that value is. And for us, what we would do is that when we have company, again, we screen a lot of companies. When they come into the zone, if they're really, really cheap, we don't necessarily say, well, I'm looking at the overall market here. That company's cheap. We buy a little bit of it. We may not buy as much as we're going to buy in the end, but you have to start somewhere if you like a company, and that's what we do. Now, in the next 6 to 12 months, that's your question. I fully expect, and maybe it doesn't work out that way, but it would have been a first for me, that all of this interest rate situations that are really pressing in everything, they're pressing mortgage rates, they're really pressing the multifamily industry, commercial real estate industry, margin debt, anything that you borrow on, okay? Banks are 8.5% prime. That's all coming into fruition now. And when that's happening all together, it sets up a situation where nothing happens for a long time and people think, well, I think it's going to be okay and everything. And then all of a sudden, everybody gets squeezed at the same time and everybody's looking for liquidity. And when you're looking for liquidity, one of the easiest places to get it, and you know this, Anthony, is the stock market, because you can sell it today and get cash. And so that's sort of what I think is going to transpire in here.
Yeah, so similar to, I guess, what we've seen in the past, these very quick drawdowns followed by maybe a longer term uptrend, which is normally what happens.
Well, I think you could see it because you have a lot of speculative money in the market. You look at, half of the options are one-day calls and that sort of thing. All that speculative money, if it gets really scared, is going to turn the other way. In other words, right now it's been turned like, on the upside, but it can turn on the downside too. And when it does, it usually is deeper and stronger than most people think. And that's how you make a really good low in the market. And then you got to get excited because you're probably going to have a good market for some time.
Yeah, which is when you look for those undervalued companies. So if we look at, you mentioned a few companies there that you've had positions in that you've then sort of gotten out, as you said, that they become higher than your expectation, and they were mostly tech stocks. So I guess what type of companies have you rotated to during this period, or sectors maybe?
Yeah, well, what does well, you've seen us, we've rotated into some more healthcare than we already had. We've added GlaxoSmithKline drug company here recently. We like these companies that can give us a decent dividend, but you have to own companies that do better in an economic downturn, and that's not tech. That's going to be consumer staples, that you want to own. It's going to be the things that, if you look out there for us, for example, it's United Health, and we've got 2 or 3 others that we own. We've got O'Reilly Automotive. We have Visa, MasterCard. See, people use cards even in bad times, and so those are types of companies we like to own through these periods. We own in income accounts too. We own a lot of energy, a lot of gas pipelines, oil pipelines, very high yields, 7 to 9% on the cash flow. And I honestly, right now, I can't find a good piece of real estate with 8 or 9% cash flow. So that works well for us. We found a number of medical REITs that we like, and there's some really great preferreds out there. The bond market set up some preferreds that you can own for, 7 or 8% on a preferred that are only taxed. They're going to be taxed like a stock, so they're 20% cap. But all of that sets up. It's just a switch. You change over to a little bit different way.
Yeah, it makes sense. And are there any, I guess, industries that you think, or sectors that you think are maybe unloved and undervalued from your perspective?
Well, oil for sure. If you think about it, it's only owned 4% of the S&P is oil. And you've had so much push into the green energy and this and that and the other, and people don't stop and realize that so many of these things. I mean, you use oil to make, if you look at wind energy, oil is used to make that equipment. I mean, I know it sounds crazy, but it's all ties together. And I think people have been sort of sold a bill of goods that we could get this quick movement to, get away from fossil fuels. And it's not that I don't think we will long term. It's just in the short run, they've misjudged it. So that group's really not owned. I'll tell you another group is gold miners. We own a gold miners. They are probably the lowest owned group right now that they've ever been since they've traded. And so if you look at these groups where nobody owns them, And those are the ones that the institutions have to come back and buy. And so they'll come back and they'll push the oils up, they'll push the gold miners up. That's the type of things that they push up. You know, they'll probably push up quite a few smaller companies, small caps. We don't own many of those, but I could see some of that, you know, really, really happening.
Yeah, makes sense, and I agree. So you mentioned before as well, property, and you think that, yeah, I guess a lot of people have maybe been surprised how, especially domestic property, how well it's held up, and a lot of the building companies has actually performed quite well. Some of the highest performers in the markets this year. So is that sort of just a very specific trend where the people who are building the homes that they can offer better deals compared to current homes, or why do you think that's occurred? And I guess, is that something that you think is going to continue, or do you think there's a risk that the high interest rates will come back to bite them?
Well, you know, what's happened is, and everybody knows this, I'm not telling anybody anything new, but with with these low interest rates, 90% of the mortgages are under 5%, 5 and under. Think about that. The rate today is a 7.58 on a 30-year mortgage, and 50% of them are under 3% or under. So those people are hanging in there, doing the best they can to try to hang around on those, hold those mortgages, hold those. They can't do anything else really, because if they go buy a larger home at a 7.5 rate, that payment's going to go up not just twofold, but it's going to go up threefold probably. And they just can't afford it. They can't afford to do that. Now, here's what happens though. People have overbought, especially mid-level to upper mid-level wage earners, two-earner families. They've overbought real estate. They have more real estate than they probably should have. I'm talking about size of a home, mortgage, et cetera, et cetera. If one of them loses their job, and we haven't gotten to that point yet, then all bets are off, because they have to sell the house anyway, okay? Or they get foreclosed on. I think that's probably the next step that comes along. We're starting to see a lot of white collar recession going on, that type of thing. And I just see that as being something that takes place. And I think that's going to change that market. Everybody talks about Warren Buffett this week buying D.R. Horton. Well, they bought $700 million worth. I mean, come on, they've got $140 billion in cash. It's like a quarter in your pocket. I mean, and maybe one of his underlings bought it. Who knows? But the main point is they didn't buy any. If it doubled, it wouldn't help them. But you know, maybe that's their way to get a foot in the door or something down the way. But I think it's too early for that stuff. If I were going that direction to go the home builders, we don't own this stock, but I've always liked it. I like Leggett and Platt. Pays a high dividend, 6% dividend, well-run company, and they really do a lot of servicing materials into the business. They do a lot of things, but a good company. And somewhere along the line, those kinds of companies are going to get bottomed, and we're going to be off to a really good move in the market. But I just don't think it's right now.
Yeah, makes sense. I guess if we look at sort of the end of last year, that's when there was concerns about earnings, stocks were going down, and a lot of those companies actually started laying off people. So if we started again, then we could see a similar trend, and that's where that, the force to sell homes might happen.
Yeah, and the reason I say that, if you look at the speculative juices, still look at the IPO that came out with the electric vehicle this week. I mean, that was a SPAC, I guess, but it's stupid, really. I mean, those kind of things happen when people are still speculating, and speculation in the long run never works. It can work for a while, actually, and I've seen it, but most people, they look at it, their greed button comes on, and then they get blinded, and they don't know what to do, and then their fear button comes on at the low, and they get blinded again, but they sell out. So we probably, we're going to see both sides of that, I think, eventually. But here, I think as an investor, you're going to have to keep your head on straight and not let what goes on out there sway your convictions about what's good and what's not good.
Great point. So, Ted, thanks so much for your time today. I really appreciate it. My last question is, what is one message you'd like people to take away from our conversation?
In talking with people, I always mention this to them. It's been 25 years almost since you could put money out on interest, guaranteed as much as you want to put out there for 5.5% over the next 3, 6, 9 months, a year. You lock it in, whatever you want, okay? All guaranteed, the U.S. government. And the CDs are high now, everything. So why not take a good bit of your money until you can see some daylight here, okay? Why not take a good bit of your money and put it in that for the time being, earn that. I told somebody the other day, I said, look, they had $2 million. I said, you realize 2 years ago, that $2 million was making you, was only making you about maybe $5,000 interest for the whole year. I said, now that same $2 million is making you $110,000 in a year. No risk, zero, nothing. So that being the case, and with a multiple on the S&P at 21, which means that's got a cash yield, okay, of about 4.5, that tells me if I can get a better yield on that treasury at 5.5 than that 4.5, I'm going to take that. And I think people need to keep that in mind. That doesn't mean you can't own things. It just said you need to have enough liquidity so that you can weather really most anything, sleep at night, be ready to go in the next morning, keep your head on straight when everybody else is going to be going nuts. You've got liquidity and you can say, now it's time to make some money. And that's what I would advise them.
Great message. So, yep, Ted, thanks again. If anyone wanted to find more about your work, you mentioned Oxbow Advisors. Is that the best place on the website, or is there anywhere else?
Well, I think it's the best place. We've written a lot of books, 9 books or so. We make those available to the public. They're not long books, but they get the subject across. We've always said you need to be able to read that book within 2 hours on a flight, and I still believe that. And we've got a new book coming out here in about a month called a balanced portfolio. We think that's important too, but that the best place to go is oxbowadvisors.com. Everything's there, and we'll certainly put you on a list, newsletter. You'll see what we're thinking at the time, and we work at it all the time. It's a learning business, but I appreciate you having me, Anthony.
Yeah, thanks for coming on. That's why we love it, because we're always learning and there's always new things happening. So yeah, thanks again.
You bet. Thank you. Hello, everyone. I just want to say, if you like this video and you want to see more of this type of information, because we really try to get the information that you don't see from anybody else, then be sure and click on subscribe and you'll see more of what we do here at Oxbow.